What is happening, people? It is your boy Jack, and today we're going to be speaking about cruise line stocks yet again. I've covered Carnival in a couple of videos already, but what I want to do today is compare Carnival against their biggest competitor, Royal Caribbean. The cruise line industry and sector as a whole is in deep waters right now, and it has gained the interest of an awful lot of investors because of this. Less than 3 months ago, Carnival was above $50 a share and is now sitting at a rather sad $8.51 a share. Royal Caribbean paints a similar picture. Less than 3 months ago, they were sitting close to $135 a share, and they're currently sitting at $24.41 a share. Today we're going to compare the two stocks and see which I would prefer to buy right now, because I don't know about you guys, but I am all about seizing the opportunity. Oh my days, the puns. But first, I have something to say to you. Yes, you, one of the 95% of people who watches my videos but isn't subscribed yet. I'm asking you to do me a massive favour and just scroll down a little bit, and you see that big shiny red button? Just click it for me, click it nice and gently, and then you'll be able to follow me, you'll subscribe to me, you'll be able to see all of my videos, and we'll live in harmony as one. And while you're down there, feel free to click the like button. Both of those things are completely free to do and supports me massively. Now, when you decide to invest in a company, it's important to never give in to peer pressure. You have to decide what is important to you. Me personally, I have very specific things I look for before I decide to invest in a company. Okay, I am sincerely sorry. I promise there will be no more absolutely horrific puns. We're just going to get into the actual juicy stuff in this video. Let's get to the comparisons. So we're going to start it off just by having a look at some comparisons that I made up earlier. We're looking at Carnival v Royal Caribbean, and all of these numbers are of last year. So we're just going to see where they ended up last year in comparison to each other. So we can see Carnival with a total revenue of 20.8 billion, Royal Caribbean with a total revenue of 10.9 billion. So straight away, Carnival are making a whole lot more money. Carnival's cost of revenue 12.9 billion and Royal Caribbean's revenue 5.8 billion, leaving each company with a gross profit of 7.9 billion and 5.09 billion respectively. So straight off the bat, we can see that Carnival are making a lot more money and are making more gross profit. And then next up, we have the operating expenses. So Carnival with a 4.6 billion, Royal Caribbean with just shy of 3 billion, leaving both companies with an operating income of 3.27 billion and 2.09 billion respectively. So straight off the bat, we can see that Carnival are making considerably more money than Royal Caribbean. And this is no surprise, because if we just go onto Wikipedia and we look at the list of largest cruise lines, we can see Carnival Corporation, passengers in thousands, so they have 12.3 million, and Royal Caribbean have 5.9 million, so they have over double the passengers of Royal Caribbean. And then overall, in the entirety of the cruise ship market, they take 47.4% of passengers, and Royal Caribbean take 23%. So that is obviously why Carnival is making more money, because they take twice as many people. Now we're just going to have a look at their assets and liabilities as of the end of last year. Now this has changed a lot. I spoke about this in my last video, but let's just see where they both ended last year, and then we'll speak a little bit more about where they actually are right now, because that's really important given what's going on in the world. So current assets for Carnival, just over 2 billion. Royal Caribbean 1.1 billion. Long-term assets 42.999 billion for Carnival and 29.15 billion for Royal. Total assets for Carnival just over 45 billion and just over 30 billion for Royal Caribbean. So we can see again, Carnival has a lot more assets as of the end of last year than Royal Caribbean. And then we'll look at their liabilities. Current liabilities, 9.1 billion for Carnival, 7.9 billion for Royal Caribbean. So they're doing a little bit better in regards to debt, but they're making a lot less money, so that is to be expected. Long-term liabilities for Carnival, 10.5 billion, and Royal Caribbean is very close to them at a 9.6 billion. Total liabilities for Carnival, 19.6 billion and 17.5 billion for Royal Caribbean, leaving the companies with a net income of essentially 3 billion for Carnival and 1.878 billion for Royal Caribbean. So to me, Carnival looks a lot better than Royal Caribbean so far, just because of the fact they're holding way more assets and they're not holding way more liabilities. They're holding slightly more liabilities. They have 50% more total assets than Royal Caribbean, and they only have, what is that, maybe 10% more liabilities than Royal Caribbean. So the ratios are definitely in Carnival's favour. And that's why I've spoken about Carnival quite a bit on the channel and not Royal Caribbean or any other cruise line for that matter. I might have made some small comparisons in previous videos, but it's because upon initial inspection, Carnival is at the top of their sector, and if you've watched any of my videos, you know that I enjoy investing in companies who are at the very tip top of their particular sector. But for the purpose of today's video, I decided to go do a little bit more research into Royal Caribbean, whatever you want to call them, man. I still don't know what I want to call them. Now, the numbers we just looked at were as of last year, and obviously it's been a crazy year so far, so there's already a lot more that needs to be taken into account. particularly how much money these companies have on hand right now, how much more debt these companies have taken on to get them through the rough times that are about to come. And now we're looking at Royal Caribbean, and we can see the company pretty much took on 3.5 billion in backup financing, so in new debt, between two revolving lines held by Nordea Bank and Scotia Bank. They said that on Thursday. They announced that on Thursday. So they've taken essentially an extra 3.5 billion in debt to try help them get through this tough times, which is what every single Carnival line, which is what every single cruise line is doing right now. Something else. On Wednesday, Royal announced that its CEO will forgo his base salary through September 30, 2020. Other executives will take a 25% hit to their salaries through the same period. So they're cutting costs, which is a good sign, and Carnival are doing the exact same thing. Royal's competitor Carnival on Tuesday announced it's issuing 1.25 billion in stock and raising 4.75 billion in fresh debt. So they took on a $4 billion bond. So both of these companies have acted very, very quickly and gotten more cash on hand to make sure that they can get through the tough times that lie ahead. Obviously, it's far from ideal for both of these companies who are in a really tough time, who are bringing in essentially zero income for the foreseeable future, to have to go ahead and take all of this really high interest debt to try and just survive. It's obviously not a good thing, but it is every cruise line's best option right now is to just, get the debt that they can and survive the tough months and hope that they'll be able to come back out on top. I think that's why it's so important to look at the bigger companies if you do want to make an investment in any cruise line right now. A lot of people are putting Carnival's kind of chances of bankruptcy in between 10 to 25%, which is extremely, extremely high. There would be no way you would invest in a company who has that chance to go bankrupt unless there was insane growth potential. And I would imagine that Royal Caribbean is somewhere along the same lines. They're in a similar situation to Carnival. So both of these companies probably have between a 10 to 25% chance of going completely bankrupt and your investment turning into zero. But on the other hand, there is massive potential for massive reward. When things turn around, if these companies, survive these tough times, the growth is going to be absolutely immense, and we could see 400-600% growth in the next 10 years, less than 10 years on these companies, depending on what happens next. Nobody knows, but the risk to reward ratio has to be weighed up. It's extremely high risk, but it's also potentially extremely high reward. Now what we're going to do is we're going to have a look at just how hard both of these companies have been hit, and they've both been hit extremely, extremely similarly. So we're starting off on Carnival, and I'm on the 3-month chart, and we can see a 3-month change of negative 82.98%. So there was a stage where they were above $50 a share. I said that at the start of the video, and the last day they closed just below $8.50 a share. And with Royal, we see a really similar picture being painted, okay? Minus 81.74%. They were up just above $135 at one stage, and now they're sitting at $24.37 as of Friday close. Very few companies as big as these two have seen dips as low as 80%. That is a crazy, crazy dip. If we just go and have a look at their max stock chart, okay? The last time Carnival was around $8.49. We have to go back all the way to 1995, before I was even born. That's the last time this stock was so cheap. They're not a new company, they're not up and coming. They are established and they are massive and they have grown so much, and now they're back to levels they were in 1995. Imagine investing in a company all those years ago, not selling, holding them forever, thinking they're great, and then boom, this happens. We don't often see companies hit 25-year lows. That's just a fact. That is something that very, very rarely happens. And if we want to see the same thing with Royal Caribbean, the last time this happened was during the Great Recession. That's the last time they dipped this low, so it was nowhere near as long ago, only just over 10 years ago as opposed to nearly 25 years ago. But nonetheless, both of these companies have been hit disgustingly hard. It's because a situation like this cannot be forecasted. If you try to take into account situations like this happening in your lifetime, you would never, ever, ever invest in a stock. Say you were thinking about getting in here during the recession and you thought, wow, this is so cheap. But what if in my lifetime there is an unforeseen pandemic that causes all cruise lines to cease operations? You would never invest, you know what I mean? You can't account for these things. Something like this may well never happen again in our lifetimes. Nobody knows. Now it could happen 5 more times. Again, nobody knows. But if we were to try and account for unforeseen pandemics every time we wanted to buy a stock, we would absolutely never buy stocks. So it's a horrible time, and for people who've been in the market for a really long time, it's even worse because they're seeing decades of progress be completely wiped out. But for people like me who are relatively new to the market, it could be one of the best times it could be the best time we ever get to get into the market, and that's why I've become very aggressive with my investing. I may never get an opportunity like this again. I could get 50 more, nobody knows, but it does seem like one of the best opportunities in recent history to get into the market. Now, are we at the bottom of the market? Nobody knows. I think the general consensus is no. Everybody expects this to go lower because the virus is what's driving the market lower, and the virus is still around. So until we see that the virus is pretty much worldwide gone, it's going to be very hard for the market to recover. I also believe though that a lot of that is already factored into the market. People already expect the market to go lower. They expected it to go lower last week, 2 weeks ago, a month ago, and that's why so many people have sold so aggressively and why the market has gone down so quickly. So a lot of what is going to happen in the next few weeks, the next month, is already factored into the market. I think now is an incredible time to buy in general. Even if things are to go down lower, another 10, 20, 30%, I still think now, as a long-term investor, is an incredible time to get into the market. That's why me personally, I'm going to keep buying the whole way down and the whole way up. I'm going to keep dollar cost averaging on all of the stocks that I believe in. I'm not going to try and time the market. That's not what I do. That's not what anybody in the world can do. We can all speculate. We can all make, our guesses, our speculations, but nobody knows when it's actually going to happen. And that's why I believe that dollar cost averaging is the way forward. If you want to believe the bottom is here, you can find more than enough articles online to say that this is the bottom. If you want to believe that the whole world is going to end and the economy is just going to disappear, you'll be able to find more than enough articles online to support your theory. So it's very hard to stay unbiased in this situation. That's why I don't try to time these things. Now, people may be asking the question, because I am primarily a long-term dividend investor. Why am I even considering these companies? Carnival already cancelled their dividend. Royal Caribbean hasn't yet, but I would bet a lot of money that they will cancel their dividend. I don't see how they can barely afford to potentially survive. They're not going to be able to pay their investors. Why am I investing in these companies that don't pay dividends? The answer is simple, is because of the growth potential. Just because I'm primarily a dividend growth investor doesn't mean that I will not invest in a company that I believe in purely because they don't pay a dividend right now. Take Delta for example. I recently invested in Delta when they were still paying a dividend with the expectation that they would stop paying it, because I just think that the growth potential outweighs the fact that they don't have a dividend. And I also believe that in the future, these companies, when they're profitable again, will pay dividends, and they will pay them aggressively. Carnival has had an amazing dividend history in regards to growth. Delta was the same. Once they started paying it about 9 years ago, it grew so quickly. Royal Caribbean, I'm not too sure. Let's have a look at their dividend history together. So right here is why I really do not believe they will keep paying a dividend. Last time times got tough during the Great Recession, they completely cut it. Now, when they started building it, very similarly to Delta and Carnival, they started building it really aggressively, and that's why I don't mind them not paying me a dividend for a while. If they have to not pay me for 2 or 3 years in order to save the company and eventually start paying me a whole lot more, and for their stock price to triple, quadruple, whatever it is, that's fine by me. I'm a long-term investor. I want money in the long term. I don't want it next week. But yeah, they only have a dividend growth streak of 8 years. The last time the economy got tough, they had to cut it. I don't foresee any circumstance where they keep paying this dividend, similarly to Carnival. So simply put, the reason why I would invest in these companies would be if I believed in them in the long term, and I believe that they will grow. I believe that the risk to reward ratio is worth it, and I believe that they will pay a dividend at some stage again. To me, all of those points have to be hit if I was to invest in any of these companies. And again, if I am to invest in any of them, for me personally, it's going to be Carnival. I have 2 full videos on Carnival. You can watch them. I'm not going to go super in depth because I was trying to just compare the two, but you always have to make these decisions yourselves. Again, I'm not a financial advisor. I'm not telling anybody what stocks to go buy. I'm just giving my thoughts and opinions and giving you some resources so that you can then go and do further research yourself. So guys, I do hope that you were able to take something from that video. Let me know your thoughts down below in the comment section. Let me know where you stand on both of these or either of these companies. If you plan on investing or if you already hold a position, I'm always really interested to know, especially with these companies that people have strong opinions on. Drop the video a like if you haven't just yet. Genuinely appreciate all of the support so much. The growth lately has been absolutely mind-blowing. It's so motivating to me. And until the next one, guys, I'm gonna have to say peace.